All right, let's review. Okay, so market basically is it puked right over here. All right, so what happened here? Um, yeah, selling pressure, more selling pressure. The market broke. No question. It's done. This is the biggest in 10 waves, it's biggest in 20 waves. All right, so after that, the market's going to go down. There's no, I mean, this is as clear as it gets. Selling pressure, more selling pressure, and takes out the low right here. Right, so it's done. It's done. After it does that, it tests and pukes. But it's this was not during I think it was last night, so you won't be able to trade it, or it was really early in the morning or last night, I don't remember. All right, and when it went down over here, finally got oversold, and then the buying came in. So this is where I knew that okay, they're gonna reverse this for sure. Why? Because look at the buying pressure. This is the biggest wave in 30 waves, biggest, more volume 28 waves, and it's coming from an oversold condition with the biggest move in over 49 waves. So you just put the facts together and you realize this is an oversold condition. It's an oversold condition, and which is climactic because it's a big move down, has not the most volume, but the most distance down, basically putting the market in an oversold condition. And what happens when you get oversold? Panic selling, panic whatever, cheap prices. So they're gonna buy, and they did. So they're buying. They're buying an oversold condition. That's what's going on here. So in this case, I'm like looking at this, and this is a very, very tricky situation because if you see what's going on here, after the buying, it tests, right? Then the damn thing went and sprung. You see this? It did a spring. Okay, that screwed things up because when it springs like that, then you have to wait for higher highs and all of that. It's a really real pain in the you know what. So here it goes down, all right? It does the spring, and here is where you know smart money's defending. Why? Because they bought this low. So they're buying again right here, volume off the bottom, buying with follow through. But of course, they will not, they're not going to let you get in that easy. So there's one more spring against the volume of the bottom. All right, so that's very tricky. If your stops aren't under the low, you're going to get taken. This is a deliberate move to go right under that high volume area because a lot of volume based traders will be placing their stops there because they're looking at the volume and where the volume is and using various volume tools. So they're targeted right there, right? Your stop needs to be below the low, not below like springs and all that. Even if it is under a spring or up thrust, it needs to have high volume, right? Because basically an area to defend. Um, anyway, long story short, look at the buying. Look at the buying pressure. This is more buying than the last 37 waves. And after that, they do another drive down to do what? Retest the spring. So this is a deliberate move also to stop hunt for those who don't have their stops under the low. And then what happens? Bang, markup ensues. So this is very, very tricky situation. You have to know what were the tip-offs. The ES kept giving buy signals like demand and trend signal, boom, boom. So it's just a matter of the market that you're trading also to give that same signal. And it finally did, but it's a little bit late. And, now it's a problem because it already rallied. So the chances of a deep pullback are not high. This chance is going to be that they've taken out this high. So and they already tested this high and rallied from it. So now for a deep pullback, it would be not really that great chance. So Anyway, as you can see, this is a beautiful accumulation range. I mean, this is amazing. Why? Look at all the elements. You have climactic action or oversold action. You have your sign of strength. You have your springs. You have your volume off the bottom. You have more buying. I would consider this also a sign of strength, but from the perspective of volume. Perspective of price and volume is this one. It could also just be a perspective of price or volume. Sign of strength can be both, at least in my book. So here, I mean, if it has more volume than 37 ways, isn't that an indication of strength? Clearly, it's an indication of buying. With a volume off the bottom, you could also call this a change of behavior, like a true change of behavior right here. Yeah, and then this is called a. Let me show you what this is called. This is called. I saw this term somewhere else, so I'm going to use it. This is called the FU harder. Right? That's the FU harder. I saw this term FU candle or something. This is the FU harder. Right? Now it tests and then it rallies. Right? And this is obviously it's in markup. Now it's going to trend up. No question. It's going to take out this high. And I don't know whether it's going to go, but to get in now, you're going to have to really have some skill. Probably want to see a drive down, take stops, and reverse. But that's another skill, like how to get into a market when it's trending. It's another pain in the butt. Because then you're waiting for springs and up thrusts, but against a breakout level, against support or resistance or something. Anyway, next market. Let's go. So this is gold. Oh, okay. So this was basically, here's the thing with gold, like really important to note why I knew that this move was going to happen. Because right here, look at the buying. Look at the buying. See that? Right there? That cluster? That is accumulation. So this means that this is forecasting the markup. The volume here is forecasting the move up. The volume here is forecasting what is going to happen. Volume forecasting price. Because of all this actions, accumulation, what comes after accumulation? Markup of prices. Anyway, long story short, rally, and right here at this point, it's in markup. The MU is in markup. So you have accumulation background, bang, bang, and then 1, 2, 3, 4, ding, rally. And here the selling pressure comes in because now you have volume off the bottom. You have this break and then this break. So that is also a break of the low. Yeah, I wouldn't want to be long after seeing this and this together because this shows that they're selling into this resistance area. Because you see, I could be wrong, but look at the thrust from here to here. It's good thrust. It's 1, 2, 3, 4 thrusts. Here to here is 2. So half the thrusts, and in the top brick, biggest volume in 100, and what happens after that? Selling. So this is an indication of a climactic brick and distribution. With follow through, breaks the low, chances are it's going to reaccumulate lower, in my opinion. Next is the crude. or the crude, right? So, oh yeah, yeah, this was the move. So I'm watching this over here. Here you have the volume of the top right there. And then you have this break, right? And this is your slightly lower low. Now it's set up a very nice trade, but 2, 3, 4, is it 3 or 4? I don't remember. Let's just use 3. All right, whatever. So over here, ding, 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 retested, but the trade it gave 1, 2, 3, 1, 2, 3, 1, 2, 3 was a 3 to 1. It was a 3 to 1 because what happened was the sellers are selling, but the buyers are buying also. The buyers were buying right here. See that? That's the biggest volume in 44 up waves. So what's going on is you have selling into buying reaccumulation, into a test of the selling area, into a test of the reaccumulation area. It's very tricky. What told me that this is going on was this. I'm using the metals index where it trended right here. So that basically saying we're gonna go. That this is uptrend, meaning the trend has changed. So be careful of your sells. So even if you take the sell, get out of 3 to 1 and whatever. Here I can't really tell. Here I can't tell. This is a volume off the top, probably against this area, selling pressure. Now we have what? Volume off the bottom. Trend has not changed, but pressure is coming in. You see the index, it's already moving 118. 118 ticks relative to the past is the biggest. So, silver and all the other platinum and all that other stuff is going. So chances are, if this breaks, that gold will also rally. And there's already buying in gold off the bottom right there. No question, right there. So volume off the bottom, change of behavior, and the index is helping me also because it's like, God, I don't know what to say. Another confirmation. It brings clarity. So this thing is going to look at this 125 bigger than 76, bigger than 73, bigger than 96, bigger than 21, blah 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 blah. So it's obviously going to go up, right? So I mean, this shit is just, I know what it's going to do now. It's going to go. It's going to take out this. Probably going to take out this, and then pull back, rally. Anyway, this right here is considered a change of behavior bar. This right here is a climactic bar. So maybe I'll use those terms instead of volume off the bottom or volume off the top. I don't really care. This is volume off the top. This is also a climax. There's a change of behavior. It's also a sinus strength bar. It's a change of character bar. It's a volume off the bottom bar. I don't know what the hell to say. This is accumulation in a bar instead of a box. Anyway, so long story short, you can actually very clearly see the price action. Price volume action. Thank you for the tip off right over there. And so see, a lot of this has to do with your ability to know Wyckoff. This all 100% Wyckoff, what I'm applying here. Only difference is what Wyckoff did was when he day traded, he used 2 types of charts. The first type of chart was was a wave chart. The wave chart of tape reading is what it's called, right? And this is what the wave volume chart, right? What's it called? Wave volume. Um, and basically, what he did with this was label it with price and time. Later on, he added more variables, such as activity. I think that's it. Price, time, volume, and activity. Those were the four things he tracked. Because okay, so that's one chart, right? The other chart was a point and figure chart intraday, but it's not like a normal point and figure. His point and figure did not have X's and O's. Instead, it had the volume in the point and figure. So you would have like, instead of an X, you would have a volume like 20. Instead of O, it would be like 30. So you have 20, then 30, then 40 in an up column, and then down column with like 15, 18, 20 in a down column. So it replaced the X and O's with volume prints. So you would use this chart, the wave chart, with the point and figure volume chart. What I've done, and based on David, is taken the Renko chart and just put volume in it. Because in my opinion, and I think David's as well, David Weiss, the Renko with volume combines the two charts, meaning it has the element of a wave and it has the element of the tape reading chart with the volume inside the bricks. So it's like a combination of both. In any case, it really doesn't matter what type of chart you use. What matters is if you understand the nuances of it. That's what it really comes down to. The charts by themselves do not give you an edge. It's your interpretation and your ability to read them that does. All right, so that's the first thing. The second thing is that I want to just leave today is with a couple of things. One, I'm going to go over the factors of the market, like from a Wyckoff standpoint. First is obviously price. Price, when we talk about price, we are looking at big waves and small waves. This is called pulling power. All right. And also, I mean, it's the distance, right? The distance of the wave. We also note as pulling power. All right. So it's like a measure of supply and demand. Which side is stronger? The side that has the most pulling power. So when you look at waves, you're seeing how many ticks up and ticks down, how big of the wave up and how big of the wave down. So that is pulling power. That's one factor. All right, these are the factors of supply and demand, by the way. Second is volume. No, it's time. Time is noted as sustaining power. Now, time is important because typically your rallies should be rallying for a significant amount of time, and your pullback should be less time. So it's sustaining power. If you just have a quick sharp move up or down, it's not sustaining. So that could be like a shakeout. So, and also you'll note that many times before the market rallies up or down, the small waves will have very little time. Like on a 5-minute chart, the little wave will only have one bar, a 5-minute bar, therefore it's 5 minutes, and then it'll break. And there will be a rally or a rally up or rally down. So time is very important, and time is highly correlated with volume, meaning more time, typically you have more volume, but not always. Third is volume. Volume, basically, I just consider it like, to keep it simple, I've heard a lot of different analogies, right? Is your force or pressure. force or pressure. Just keep it simple. So when you look at volume and you see all that force and all that pressure, the question is, what did it do? When you see all that force and pressure, aka effort, what was the reward, right? So force and pressure, very important. The fourth factor is activity. Activity, we don't really use it, but Wyckoff used it and it was proprietary. He didn't give the formula for it. All I know is that it's similar to, I don't want to go into it because it was proprietary, but basically it functions, it's correlated to volume. I know that it's correlated to volume. And also, there will be, uh, from another activity standpoint, you're looking for time of day where there's a lot of activity, there's a lot of orders, and those orders are moving the market. So you need activity, otherwise there's no buyers and the market's not moving. So you need markets to be active. See right now, look at this shit. It's stuck. It's not even moving. So if you don't have buyer, it's not moving because there are no buyers, no sellers, no pressure. It's not going to go nowhere. So you need activity, and just think about activity like that. He used to do something else with activity. I forgot what it was. But anyway, the next factor is support and resistance. What is support and resistance? Support and resistance, or at least how I understand it, is like the pivot. Why is it called support and resistance? Support is when demand overtakes supply. So when demand overtakes supply, you have a point of support. When the supply overtakes demand, you have a point of resistance. And that's what's creating the swing low and the swing highs. The swing low, swing high. This high over here, when it turns, it's because supply overtook demand. This high here is because supply overtook demand. This low here is because demand overtook supply. So support and resistance is your pivots. And why is it important? Is because it indicates where supply overtook demand or demand overtook supply. And it is a roadmap. It is your guide. It is a roadmap because it basically, it sequences and creates trend, right? So that's your roadmap. And it offers, and you're supposed to trade as close to support levels as possible or right under them, because that's where demand overtook supply and supply overtook demand. And also be aware that stops are there and all that. So, and 6 is trend. Trend is like insurance. I mean, if you see a lot of, first of all, before let me explain that, yeah, it is higher high, higher lows. Yeah, okay. But it also means that the up waves are bigger than the down waves. What is the consequence of that? When the up waves are bigger than the down waves and you're trading with the up waves, your R will be bigger. Okay, your R will be bigger. Your reward will always be bigger. That's huge. That's the reason, one major reason to trade with trend, because the reward will be bigger. The second is the probability will be higher of success than counter trending. And the reason is because you have a directional bias. So the direction, is, take a look right in front of you. If you counter trend, look at these waves. Look how small they are. Look at the trend wave. 1, 2, 3, 4, 5, 6, 7, 8, 9. Look at the counter trend. 3, 3, 2, max 4. Look at this. 1, 2, 3, 4, 5, 6, 7, 8, 9. Look at this. 3, 2, 3. Obviously, your R is higher with trend. And the probability will be higher. The third thing is, when counter trending, you are more likely to get up thrusted or sprung. that's if you see accumulation or distribution after it moves and you're in, there's a likelihood of there being a upthrust after distribution or a spring after accumulation when you counter trend. So you have all the things that are against you. One, small r, the same amount of risk. Two, less likelihood of success, and I'll explain that a little bit more. Three, more likelihood of getting sprung, especially by wicks. All right. Now, the other thing about trend is it automatically has more probability. It's automatic. It has more probability. Why? If you're trading with trend on any time frame, chances are not only are the trend traders on your side, but the higher time frame traders are also on your side. Why? Because higher time frame traders use lower time frame trade ch- uh, charts for entry. So you already are adding an additional group of traders to your what is it? To your side. So by using the higher time frame and a lower time frame, you have two groups: those who are on the lower time frame plus those who are on the higher time frame. If you are countering against the higher time frame, you only have one group, the counter trend traders, and you're actually against the higher time frame traders. There's another group which is stronger because they have more capital, more risk, and they're against you. And that's the way I view it. Um, and now from an insurance perspective, there's a lot of individuals, they don't know anything about trading, but they've just gone long. They've gone long in their accounts, 401k accounts, and all of those accounts. Look at what happens to those accounts. They're called 401k millionaires. They don't know how to trade. They've never traded. All you know is that they bought and they just hold, and the trend was up. And look what happened. Even when they're wrong, meaning the market goes down, 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 a higher time frame from the monthly or weekly has saved them. And so that's what I mean when I say it's like insurance, because the other time frames, if they will be buying pullbacks. So all right, that's enough for today. Thank you.